Hey, question for you. Are you currently utilizing the most tax preference account available to retirees right now? Now, in our practice, we see a lot of retirees come through our practice that we meet with, and typically a lot of people that we're first meeting with, unfortunately, aren't utilizing this account. They haven't been contributing to this account, and sometimes they don't even know about what this account is. And so in today's video, we're going to be talking about the ins and outs of this account, how to properly utilize it within your retirement, and the benefits and drawbacks to this account. And really, this account is going to help you avoid taxes on one of your largest retirement expenses. Now, before getting into this, if you watch this video till the end and you end up liking this video, please do me a favor, hit the like button down below. It helps the YouTube algorithm essentially recommend this video to other retirees just like yourself, as well as if you like this video, maybe you've watched a few of our other videos, please hit the subscribe button. You'll be notified of all future videos that we release on how to improve your retirement through things like using this triple tax savings retirement account. So let's get into it. Now, with each account that you normally contribute to, and we have three different tax buckets here, you are giving up something and you're getting a benefit. Okay, so it's all about managing these accounts and having tax diversification through these three buckets. Now, let's take a taxable account, a non-qualified account, a brokerage account. Now, when you contribute to this account, you're contributing with after-tax dollars. So you're paying taxes on the money that you contribute, but the benefit of this account is essentially if you use this account properly, the growth within this account will be at a tax preference rate, at long-term capital gains rate, which is lower than income rates at any given point. Okay, second, you have your tax deferred bucket. This would be traditional IRA contributions, traditional 401k, and you get a tax break when you contribute to this type of account. Now, the problem is when you take this money out in retirement, you'll owe taxes. So oftentimes this account can be used strategically to earn a tax break when your taxes are higher, potentially while working, in order to essentially take that money out at a lower tax rate sometime in retirement. But obviously there are a lot of traps that we've talked about in other videos with this tax deferred account. Finally, you have your tax-free bucket. This would be money like a Roth IRA. Now you pay taxes on this when you first contribute to this, but then the growth as well as withdrawals from there on out are completely tax-free. So each of these buckets offers a given benefit if you use it strategically, but there are also things you are giving up with each of these accounts. Now there is one given account where you're really not giving up anything, and this would be your health savings account, otherwise known as an HSA. Now this is a triple tax savings vehicle. And here's how it's a triple tax savings vehicle. So there are no taxes on the contributions. So just like a traditional IRA or traditional 401k contribution, you will not pay taxes. In fact, you'll get a tax deduction in that given year. Then there are no taxes on the growth. Okay, so that money can grow within this HSA account without having any taxable events. And then no taxes on the withdrawal as well, on the distribution, if you use this for qualified medical expenses. Now, we will cover what a qualified medical expense is here in a few slides. However, again, if you're thinking about this in layman's terms, you're essentially, the money that you are contributing to this account, if you use it properly, is exiting the tax system completely. Okay, now for a married couple, if you qualify to contribute to an HSA, the limit is $9,200 in 2021. That is if both people in the couple are over 55 and they get a $1,000 essentially catch-up contribution. So if you're not over 55, your limit for a couple in 2021 is $7,200. But again, this is a triple tax savings vehicle. No taxes on the contribution, no taxes on the growth, and no taxes on the withdrawal if you use it for qualified medical expenses. So we can start to see how powerful this account can be if you utilize it properly within your retirement. Now, it's important to note that healthcare is going to be one of your largest retirement expenses. And so this is a specific healthcare savings account. To get the most benefit out of this account, the distributions have to be used for qualified medical expenses, but there really shouldn't be too many worries that you will have qualified medical expenses throughout retirement. Because again, at any point in retirement, healthcare can be fairly expensive. It's, again, one of your largest retirement expenses. So if you're retiring prior to Medicare, okay, you have the ACA insurance years, the Obamacare years, or you can take some kind of continuation from work. Now, this can be fairly cost effective if you earn a subsidy on Obamacare, or it can be fairly expensive if you have unsubsidized COBRA insurance. From the time that you're 65 until essentially what we would call your no-go years, those are what we call the healthcare preferred years. Once you're on Medicare, you're not having to try to report a low income to earn a subsidy, and these are fairly cost effective years. And then during the latter years of your life, the no-go years. Potentially, if you have long-term care needs within these years, again, that can get fairly expensive. So at every point in retirement, there are qualified medical expenses that you will likely have, and thus can use this health savings account. So how do you qualify in order to contribute to an HSA? Well, you have to qualify based on a high deductible healthcare plan. Okay, we're going to focus here on 2021 qualifications. Now, this is taken right from healthcare.gov. I simply screenshotted this right from that healthcare.gov website. And as you can see, it says for 2021, the IRS defines a high deductible healthcare plan as any plan with a deductible of at least $1,400 for an individual or $2,800 for a family. Now, it's important to know there is a minimum deductible that you have to qualify in order to have what is considered a high deductible healthcare plan. But there's also a maximum out of pocket as well that can disqualify you. So if your total yearly out of pocket expenses are more than $7,000 for an individual or $14,000 for a family, that would disqualify you for an HSA. So again, understanding what qualifies as a high deductible healthcare plan is very important. For 2022, the high deductible standards are going to be the same: $1,400 for an individual, $2,800 for a family. The out-of-pocket costs are going up $50 for an individual and $100 for a family. So if you qualify for an HSA through a high deductible healthcare plan, you can contribute, again, to that HSA, obviously. Now, oftentimes, or I should say sometimes, if you qualify at the job that you're currently working at, you may have an employer-offered plan, meaning that, again, right out of your paycheck each and every 2-week period or month period, however you're paid, you can essentially start contributing right out of that paycheck. Again, if it's an employer-offered plan. Now, most people think, okay, if my employer doesn't offer this type of plan, I simply can't contribute to an HSA, and that's not true. Okay, you can go outside of your employer plan and go to an independent plan. Now, there are a lot of different independent plans out there. We don't get paid for recommending any given plan, but a great option that I would recommend a lot of people look at if you're watching this video looking for that independent plan is a company called Lively, Lively. They have very low to no fees and a lot of different abilities to essentially invest and grow that account essentially beyond that. So they're a great independent provider that we often recommend for our clients. Okay. Now, it's important to know when you distribute from an HSA, what's a qualified distribution and what are the tax implications of that qualified distribution? And then what is considered a non-qualified distribution? And again, what are the tax and penalty implications of that non-qualified distribution? So an HSA is going to look very different and work very different than normal retirement accounts. Some things will be similar, but again, they'll work fairly differently. So first, let's talk about what a qualified distribution would be. So this is if essentially you take money out of this HSA for qualified medical expenses. Now, pretty simply, these are tax-free. There's no age that you have to essentially meet, like 59 and a half, in order to use qualified distributions. Okay, you can be age 30, you can contribute to an HSA at age 30 and use it the following year. If it's for a qualified distribution, a qualified medical expense, you can take that money out completely tax-free. So there are no age requirements when it comes to a qualified distribution. The full amount is tax-free when you withdraw that. Now, non-qualified distributions can get a little bit more complex. Okay, so rather than 59 and a half, now normally, let's say with a traditional IRA or a Roth IRA, we have that 59 and a half rule, meaning that we mostly can't take money from those accounts, minus a few exceptions, prior to 59 and a half. If we do so, we'll typically owe tax as well as penalties. Well, similar things work out with a non-qualified distribution from an HSA. Now, rather than it being 59 and a half as that age limit, the age limit is actually 65, okay? So if you're younger than 65 and you take money out of an HSA for a non-qualified medical expense, you will not only owe tax on that distribution, so just like with a traditional IRA, when you're taking money out of that account, you owe tax. So essentially an HSA for non-qualified distributions turns into a traditional IRA in a sense. You'll have tax that you owe on that distribution plus a 20% penalty. Now, again, this is if you take money out for a non-qualified distribution prior to age 65. Past age 65, your HSA in a way turns into a traditional IRA for non-qualified expenses. So over 65, let's say that you have too much money in your HSA and you don't think you're going to be able to use this before you pass away. Well, you can take money out of this HSA as a non-qualified distribution and you'll owe no penalty. You'll just owe tax on that distribution. So again, this is why I said after age 65 for non-qualified distributions, your HSA in a sense turns into a traditional IRA. Now, there is a very interesting ripple, which is why I make a case for a lot of our clients to make sure they're contributing to an HSA each and every year. Contributing to an HSA, let's say your worry is over contributing and you think you're going to need to pull money out for non-qualified expenses. Well, again, it turns into a traditional IRA, but the very important ripple here is that with an HSA, there are no RMDs. So for instance, if we contributing to a traditional IRA, and let's say we don't need that money, at age 72, the government is going to force us to take money out of that account. Versus if this money is locked up in an HSA and you're going to use it for non-qualified distributions, you won't have that RMD. So you have the optionality to pick and choose when to take those non-qualified distributions. This is very important. Again, in tax planning and retirement, we don't want forced income. RMDs are forced income. HSAs, there is no forced income that you will essentially have to take, minus passing money on to the next generation. But we'll talk about that in here in a sec. So what qualifies as a qualified medical expense? Well, there is a long list. I urge everyone that's watching this video that has an HSA to talk to their HSA provider and get a list of qualified medical expenses. We have a lot right here on the screen. I'm not going to go through this line by line, but basically if you have a medical expense that pertains to your health, okay, there is a good chance that will, again, in terms of widely accepted medicine, if it will improve your health, that's likely going to be a qualified medical expense. If not, if it's more of a homeopathic or holistic type of medical procedure, that may not qualify as a qualified medical expense. But again, the IRS has these qualified medical expenses laid out. A lot of HSA providers, I highly recommend you go look at a complete list of what qualifies for medical expenses. But again, it's important to know there are a lot of things that qualify for medical expenses. Certain healthcare premiums, certain insurance premiums also will qualify for HSA qualified expenses. Now, some won't as well. The first one is long-term care insurance. Most long-term care insurance, again, the insurance premiums on that policy will qualify as a HSA expense. Okay, COBRA, those that are retiring prior to 65 that are taking unsubsidized COBRA from their work in order to meet that gap from the time they retire to age 65, that will qualify. It's important to note that ACA premiums do not qualify. So if you go onto ACA insurance, Affordable Care Act insurance, using HSA money is a non-qualified expense, unless you're on unemployment compensation. So let's say that you lose your job at age 58 and you go on to unemployment compensation. Well, then if you go onto ACA insurance, then you can use an HSA as a qualified premium expense. It's also important to know that those that are over age 65, premiums for Medicare A, Medicare B, Medicare HMO, and then the employee share of premium for employer-sponsored health insurance does qualify. Now, Medigap policies will not qualify. There are a couple things when we talk about the value of an HSA contribution that is important to know. So first, contributions are limited, meaning that generally you cannot qualify on ACA insurance to contribute to an HSA. Okay, there are some plans, I would say something like 20% of the plans that you can qualify when you're on ACA insurance, but most of them won't. Most of the time, it's not cost effective to try to qualify for HSA contributions when you're on ACA. It's also important to note that you no longer can contribute to an HSA when you're on Medicare as well. So essentially for most families, once you're over 65 and on Medicare, you have to stop HSA contributions. So you have a small window of opportunity if this is the first time you're hearing about HSAs in order to contribute to this type of account. Now, there are some interesting strategies where high income earners can use HSAs to offset small Roth conversions. So for instance, if you earn too much, let's say you're a married couple within the 24% bracket, you may not be able to contribute to a Roth IRA in a given year, meaning the only way to get Roth dollars is through a Roth 401k or through a Roth conversion. Well, again, an HSA contribution can be used strategically to do small Roth conversions. Now, why would you want to do a Roth conversion if you're in some of those higher brackets? Well, in order to start the 5-year contribution rule, potentially. Or if you have way too much in tax-deferred accounts and you're fine paying at the current tax rate that you're at, a conversion can still make sense. So if you perform an HSA contribution in 2021 of $9,200, that's going to lower your income by, well, $9,200. Well, you can then make a Roth conversion for $9,200 and essentially cancel out that deduction. So you get that HSA deduction, but then you fill that deduction back up with a Roth conversion. So again, this can be used strategically, specifically to start that 5-year contribution clock, okay? we could make the case that HSAs are actually quadruple tax savings. The reason is because they're payroll tax deductible. Now, when you're contributing to your traditional 401k, you're still owing FICA taxes on that contribution. So it's not fully deductible. HSA contributions are fully deductible. Now, for an employee, you pay 6.2% into Social Security and another 1.45% into Medicare. So having FICA deductible contributions means you're essentially saving another 7.65% on that contribution, which is pretty powerful. And again, it's important to reiterate, this money exits the tax system. If you contribute to a tax deferred account, yes, you're still getting that deduction, but eventually down the road, you're having to pay taxes when you withdraw that money out. Contributing to an HSA, you're completely sidestepping the tax system. Now, in terms of contributions, you have until April 15th in order to make a contribution. So if you're wanting to make a contribution for 2021, you'll have until April 15th of 2022, okay? There's also the ability to do a one-time HSA rollover. Now, this is a once-in-a-lifetime per person where you can perform a rollover from a traditional IRA to an HSA. Now, we often get a lot of questions on this. For most people, I don't view this as a huge opportunity. For one reason, it's only a once-in-a-lifetime rollover that you can perform. And the most you can roll over in a given year is the contribution limit. So this can be somewhat powerful for those that are trying to get monies in HSAs prior to 59 and a half, because again, they can't take from their traditional IRA. And so this one-time rollover from that traditional IRA to the HSA can be a reasonable idea, something you might want to take advantage of. For somebody over 59 and a half, I don't really see a point in this one-time HSA rollover. The reason being is because you can take from your traditional IRA in a given year. Let's say you take $9,200 in 2021, and if you contribute that to an HSA, you're essentially canceling each other out from the tax standpoint. You're taking money out of your traditional IRA, $9,200, that's taxable income. But then when you contribute to that HSA, you get that tax deduction. Okay, so you're essentially canceling those two things out. So over 59 and a half, this rollover idea doesn't really have too much value for retirees. Okay, now let's talk through a few common health savings account mistakes. A big one is unused HSA funds at death. The reason being is because you never want to pass an HSA on to the next generation because it becomes a fully taxable event. Now, if one spouse passes away and the HSA is in their name, they can pass it on to the surviving spouse with no tax consequence. Essentially, it's just like an HSA transfer to that other spouse. But passing that on to the next generation means it becomes a fully taxable event. If you have $100,000 left and you pass away and you pass it on to your son or daughter, that immediately becomes a $100,000 taxable event for them. Okay, leaving your HSA invested in cash. Now, this is something I see a lot of retirees do because at the end of the day, we don't know when we're going to have those medical expenses and when we want to use the HSA dollars for. And so they simply just leave it in cash. But if we think about this, this is our most tax preference account. We don't want to just have the value of this account come from contributions. We want to have growth in this account as well. So we'll record a few videos in the future on how to invest your HSA properly. Another big mistake we see is paying high HSA fees to, well, your HSA provider. A lot of HSA providers charge you fees on investing. They charge you fees on having that account open each and every month. And so there are other providers that don't have any fees, such as Lively, as I mentioned earlier, Lively. So there are some extremely low-cost providers. So you shouldn't have to pay those high HSA fees. Again, that's just destroying value of this tax preference account. Now, the final mistake is thinking you have enough in your health savings account. For most retirees, I would rather they over allocate to this account. The reason being is because, again, even if you don't end up needing all of those dollars for medical expenses, you can still withdraw that money and simply treat it like a traditional IRA without those RMDs. So I would rather you contribute to an HSA, even if you don't essentially use it all for those qualified medical expenses, because it's essentially a better traditional IRA after age 65. The other thing to note is for most retirees, you will have more than enough medical expenses throughout your retirement. Again, it's going to be one of your largest expenses. So most people will fully use their HSA funds to pay for those medical expenses. And then again, you get those triple tax savings. So hopefully this was informational. Contributing to an HSA and utilizing it properly within your retirement can be a fantastic way to avoid the tax system. Anytime we avoid taxes, that is a tally in the win column. So always remember, you don't need more money. You need a better plan. If you like this video, please leave a like below. If you haven't yet subscribed, hit the subscribe button. We release videos weekly. You'll be notified of all future videos that we release. Thanks for watching, and we will see you in the next video.